Okay, so here is a trading strategy using gaps, candle gaps. Some people might call them fair value gaps. Gaps have been around for a long time, not discovered or invented by ICT, been around for a very long time. And they are useful in the sense that they represent usually, always an area that the market moved through very quickly, an area in price that the market moved through very quickly, and generally that means that there was low volume traded in that area. So obviously, not all of these gaps are created equal. Not all of them are useful. But one thing that you can do is combine it with the swing indicator. I have here on the chart swing set to 5. I'm using a 15 range chart on the MNQ. You could do this with the full-sized NQ contract, but you'd of course be risking a lot more money. So depending on the size of your account and your risk tolerance, you can size up micros or use a mini or multiple minis. Obviously, all of that's up to you. But what are the entry parameters? When do you want to enter into the trade using a gap? So one of the things that you want to look for is a break in the structure of the market from bullish to bearish or from bearish to bullish. So without knowing anything that is on the left of the chart here, what we know right at this moment is that the market structure was bearish on this candle. It had broken a swing low, and then it broke a swing high right here. So as far as we know, up until this moment, up until this moment, the market is bullish, right? So we would be looking to enter into a long position. So we have multiple candle gaps that are all stacking on top of each other. This one here, between this bar and this bar, there's a gap. So what does gap mean? It means or how do we put it into more specific terms? The price from one bar ago is, the price low 1 bar ago is greater than the price high 3 bars ago. That's how you can define that. So when this bar closed, technically there was a gap there, but there was no kind of opportunity to use this gap to enter a long position because the nature of range charts, this candle immediately entered into this gap. So you wouldn't have had enough time to react and enter a long position there. So really the first opportunity that you have to enter a long position would be right here. So you'd enter a long position there, and your stop goes below the first candle in that sequence that created the gap. So if there's a gap between this bar and this bar, this one is the first one in the sequence. So your stop would go one tick below that. Now in this case, you also have a gap on this bar. So although you would be entering a long position here and exiting it there, wouldn't make a whole lot of sense to exit there because another entry exists right there. So what you could do is enter again there, and your stop would go below this bar here because it was the first one in the sequence that created this gap. Okay, so obviously this is a losing trade. So we enter here, we enter again right there, and then we're stopped out down there. Okay, now the structure has shifted to bearish as of the close of this bar right here. We have a gap right there. If we're quick enough, we can enter short right there. Our stop would be above this bar here. And we have another gap between this bar and this bar. Let me mark those up here. Between this bar and this bar, there's a gap. And then again, between this bar and this bar, there's a gap. So we'd be entering short there. Our stop would be above this bar, and then we'd enter short again on this bar, and our stop would be above this one. So we're entering multiple positions here. You can see again another gap, another entry right there, another gap, and another short entry there. Stop would be above this bar. Where's your target? Usually when the market's trending down, you just want to target the low, but obviously you can go for larger targets if you want. Market structure shifts to bullish as of right there. Get stopped out below this bar here if you entered into this gap. More gaps are created, looking for an opportunity to go long. First one we get is right there. Another gap, another gap, another gap, another gap. Another opportunity perhaps to go long right there. Or if you didn't quite get filled that time, you could be filled right there. You have another long right there. Stop is below this bar. Target is the high. So there we go. Hopefully that makes sense. It's just a really quick strategy, a way to use gaps to enter in to a trend based on market structure.